Investors are increasingly factoring long-term AI disruption into valuations, challenging traditional market metrics and highlighting future uncertainty. In an unusual market twist, investors are increasingly concerned about the long-term risks posed by artificial intelligence, leading to a noticeable sell-off in specific tech sectors. This comes despite many companies reporting impressive corporate earnings. For instance, the S&P North American Technology Software Index is down 19% from the start of the year, reflecting significant investor jitters. This apprehension signals a fundamental reevaluation of business models, as the disruptive potential of AI now weighs heavier on investor minds than current profitability. Just a year ago, AI was largely seen as a growth accelerator, driving massive rallies in AI infrastructure and chip companies. However, the narrative has evolved. What was once unbridled optimism has transitioned into a more cautious stance as the practical implications of widespread AI adoption become clearer. This shift is reflected in analyst reports, which are increasingly emphasizing AI's potential to displace human labor and disrupt established industries. This evolving perspective marks a critical turning point for market watchers, moving from "how can AI help us grow" to "how will AI reshape our competitive landscape?" The primary drivers behind this investor apprehension are multifaceted. Firstly, there's a growing realization of AI's capacity for widespread job displacement, particularly in white-collar sectors like customer service and legal services. Secondly, the competitive landscape is rapidly shifting, with AI-native startups challenging incumbents and forcing established companies to heavily invest. Lastly, concerns about the return on massive AI infrastructure spending are mounting, with some analysts noting a sell-first, think-later mindset around these investments. This confluence of factors creates a fog of uncertainty for long-term growth projections. While AI leaders like Microsoft and Alphabet saw strong Q4 earnings, other areas are experiencing significant pressure. Traditional IT services and software firms like Gartner, whose stock fell 30% on February 3rd despite strong earnings, are facing scrutiny. Wealth management and brokerage firms, including Charles Schwab and Raymond James, have seen shares decline by 7% or more due to fears of AI tools disrupting client services. Legal data providers such as RELX and Thomson Reuters also face sharp sell-offs, with RELX falling almost 11% in a single session after an AI legal tool was released. This highlights how investors are actively distinguishing between AI enablers and its potential casualties. Looking ahead, analysts are closely monitoring several key indicators to gauge the long-term impact of AI on market valuations. Many predict a period of increased volatility and selective repricing across various sectors, with a sell-first, think-later mindset prevailing. As Matthew Mish, a UBS strategist, recently stated, the timing of AI disruption remains indeterminate, and the fog of uncertainty is unlikely to dissipate quickly. This sentiment suggests that upcoming regulatory announcements and major tech conferences showcasing new AI capabilities will be crucial for understanding future market movements and how companies plan to adapt. The ongoing market dynamics underscore a critical lesson for the investment landscape. The future can matter more than today's profits. Companies that proactively integrate AI and adapt their core strategies are poised to differentiate themselves from those clinging to outdated models. The next few quarters will likely reveal which businesses are successfully navigating this seismic technological shift and which are falling behind, fundamentally reshaping investment priorities. This is GeeseFinance.